can you explain what a put credit spread is? Yeah, of course I can explain what a put credit spread is. So, Ivan, the reason I'll start with this. The reason I like spreads is because you can do them with little collateral. So it's good for small accounts. And that's what I used to believe when I first started doing spreads. And then I stopped doing them because I realized that there's not a lot in it for you at the end, except for maybe a little bit of money. Like it's not worth it to do spreads. If you do spreads because you like them, then that's one thing. But if you're doing spreads just because you have a small account, not a good thing. Not good at all. Like, don't do that. So we have debit spreads and put spreads. In both cases, one involves a call, buying a call, and then selling a call. Or one involves buying a put and selling a put. When we buy options, we pay premium, debit. When we sell options, we get money, credit. So if you sell a 2-option order and the money that you collect from the sale is more than the money that you pay to buy the option, then you get a credit spread. So in a put credit spread, what that would mean is that you are going to sell a put closer to the money. And by the money, I mean the share price. Because the closer to the share price you are, the better the premiums are probably going to be. Then what you're going to want to do is you're going to want to buy an option that's further out of the money. That's not going to be as much money. Hold on, I'm just going to bring up a stock just so I can look at it. Let's look at Apple. So let's say we go out to the 28th. The 28th. So if we look at the share price right now, here are the premiums. They go from, this is right now if I'm buying a call. Okay, so these are out of the money. Can't exercise these, 280. The further in the money I go, the more expensive they get. Okay. Now let's just go to sell. We're doing, what do you want to do? You want to do put spread, put credit spread. So if we look at puts operate the other way. So if we were to buy a put, they're more expensive up here. Out of the money is down here because we need the share price to drop down. Okay. So these are out of the money. So with a put credit spread, what we would do is we want to get a credit. So that means we want to be closer to the money with the sale of our option. So if I was to sell a put for Apple at $165, if I add that in there, I'm going to get a credit of $247. But I don't want this to be naked. So I need to put up the cash collateral to write that cash secure put. That's $165 times 100. You need $16,500 to write that CSP. But if you were to buy a put with that right under it, and you can go anywhere you want, the further away you go, the more collateral that you need. Okay. But let's say we want to go here, 129. What you'll see is that I'm going to collect 247. I am going to pay 129. That is going to give me an overall credit, which is why they call it a credit spread, of 118. Now, why on earth would you do this? Well, you do this because the collateral that you need is no longer $16,500. It's just the difference in your strike prices. So this is a difference of what? $250. So if I continue, good for the day. Where does it say my collateral down here? Review order. There's my collateral right here, $250. So the reason you do this is because you need less collateral. But the thing I don't like about it, Ivan, is that at the end, there's no exchange of stocks. It's just an exchange of money. So that's where it kind of got like gambling for me. So like in a CSP, you put up money as far as collateral, but then you get shares. You either have to buy shares, like with the wheel strategy, you either sell shares or get shares. So there's at least an exchange of a tangible asset. In spreads, there's not. And you'd be like, Brad, you love diagonal calendar credit spreads, which is the poor man's covered call. Yes, I do. But I like them long term. It's these short-term credit spreads that I'm just not a big fan of. I am more of a fan of debit spreads because debit spreads are at least long-term where you need things to happen in your favor. But I guess I hope that explains it. Ivan, if you have a follow-up, let me know. But a put credit spread is essentially when you sell a put closer to the money than you buy a put Because of that, you get some money. If you want your max gain is if the share price stays above your short call, short meaning the one you sold. You have a little bit of loss if it ends up in between, which is not a great situation for you. And your max loss is $250 if it drops all the way below the lowest strike. Appreciate the question, man. Appreciate the question.